Well, we've got a rather aggressive agenda today. There's a lot of questions that folks have about these clean technology tax credits because they will have wide and sweeping implications for all those companies that have clean technologies, have been building clean technologies for the last few decades, as well as the companies that might be implementing those technologies, be they mining companies, power producers, or retrofitting buildings. So it's going to have they are all going to have some very interesting implications, and we're looking forward to at least trying to give you a little bit of a sense of what we think may be the way that these will roll out. So without further ado, why don't we get started? First of all, today I wanted to do a quick land acknowledgement. I am actually in Toronto, so this land acknowledgement is actually correct. So this is the traditional territory of many peoples, but including the Mississaugas of the Credit, the Anishinaabe and the Chippewa, and the Haudenosaunee and Wendat peoples, and is now home of many diverse nations, First Nations, Inuit, and Métis peoples. Thank you for hosting us. Quick bit of housekeeping. We are in webinar format. We were heavily oversubscribed. There's a lot of interest in this topic. So our normal meeting format where there's a little more interactivity, we couldn't implement today. So we are recording. If you do have to step away, we'll be processing that recording and sending that out hopefully over the next week or so. And if you have any questions, please put them in the Q&A. We will respond to them as they're submitted, and get through as many of them as we can. It is a very packed hour with 3 new tax credits with a lot of not a lot of detail. So I'll skip this, except to say that for those that don't know, I have also joined Venbridge as of last year, which the topic of tax credits certainly is near and dear to me for that role as well, where we provide financing against currently primarily SHRED and other tax credits, but certainly these are tax credits that we are looking forward to working with as they roll out. So if you've got any questions about the financing side of the equation for tax credits, certainly do let me know. And I would very much like to say thank you to all of our partners that make these possible. So our wonderful Lynn Cote, who is here from EDC and joining us on the panel, Swan Law, Global Affairs Canada, and the Trade Commissioner's Service, who are wonderful partners, the City of Toronto and their Startup Here program, and the Open Data Society of Canada. And we have some wonderful speakers today. Jigna, and I'll let them introduce themselves, but Jigna, who's been a friend of CleanTech North and myself for a long time and is in practices in and around this area and incentives. Jonathan Garbett, who I have also known for quite a while and has some special connections to the Trade Commissioner's Service himself, but also is well known for his work with litigating against SHRED cases, and I believe winning those. So if you've got questions on that side, certainly that's something that he can speak to. And then, as I say, our wonderful Lynn Cote. So I'll let maybe just in that order, maybe say just 2 or 3 words about yourselves.
Thanks, Brian. Hi, everyone, and good afternoon. And like Brian said, hopefully it's nice and sunny wherever you are. It's a gloomy day here in Toronto. My name is Jigna Shah. As Brian mentioned, I'm a partner here at Deloitte in the Global Investments and Innovation Incentives practice. In this practice, what we do is support companies with their needs for non-dilutive financing, so programs such as the SR&ED or the SHRED program, and several other government grants and incentives. Thank you.
John.
Yes, hi, my name is Jonathan Garbett. I'm a Canadian tax lawyer. In addition to litigating tax matters, I do a lot of tax planning, cross-border, Canadian companies going global or American or global companies coming to Canada. Yes, I have litigated a number of SHRED cases and have a number of ongoing SHRED cases against the Canada Revenue Agency. I guess I'm going to be here a little bit of a downer to sort of point out all the places in the legislation that I see that if the CRA wanted to deny these credits, where they would stick the knife in and twist. But I guess in some ways, we want to be realistic about how this might actually roll out. So if I seem a little pessimistic or downer, it's just because of my particular experience. Let's put it that way, and I'll let everybody else be more positive.
We just want to take the risks that and mitigate those at the front end, as opposed to letting people step on the landmine.
Exactly.
First. So no, that experience is very useful. Lynn, over to you.
Hi, good afternoon. Bonjour. My name is Lynn Cote. I'm the National Lead of CleanTech Ecosystems and Market Intelligence in Export Development Canada's CleanTech team, and been doing now CleanTech for about 13 years and have worked closely with, been my pleasure to work with Bryan for many of those years.
Great. And Lynn, did you want to give a quick intro to the topic today, the topic at hand?
Sure. Happy to do that. So, one of my colleagues asked me today, he goes, "You're not on the panel, are you?" Because he was a little bit concerned. I said, "No, the only thing I'm good at with taxes is paying them, begrudgingly, admittedly. But no, I mean, we from our practice call on Monday, we have amazing expertise here on a topic that is crucial for Canadian clean tech, and a lot of work went into speaking to many people in government to make this happen. So I want to applaud, my colleagues in the clean tech ecosystem, Canada Clean Tech Alliance. I also want to applaud my fellow partners in supporting this event from the Trade Commissioner Service, Evelia Manak and her team. I think we recognize that this is a very, very important piece of opportunity, but like every opportunity, there's always challenges, and having expertise. And at this point in this part one, I love the format that Bryan's put together. Part one is really about what do we think is going to happen, and part two will be, okay, it's happened now, what do you need to do about it? Because the credits are not nothing, and if you're in the hydrogen or CCUS sectors, they're quite big. So I think understanding what it means, how can you use them, how can you monetize them, who gets them, I think is really critical to our understanding. I know that there are a number of people today who found out today that we were doing this, and they were like, okay, can we come? Because they wanted to hear comments from the ecosystem. So please send in your questions. We're very much looking forward to them. So that's really it for me. I'm going to pass it on to the experts, but what I do want to sort of emphasize is how these can be game changers for many companies in the clean tech ecosystem. So I think it's really important to, if you don't have your own expertise, get somebody who will help you navigate these things. Just like SHRED, unfortunately, they're never easy, and you're likely, I'm guessing, to need some help. But the amount on the table are very big, and they're meaningful, and we need this to happen, because these are one of the things that will help investments, capital to flow into projects that will reduce GHG emissions both in Canada and across the planet. So on that, I leave you with my learned colleagues.
Thank you very much, Lynn. And yes, don't forget to use that Q&A function if you've got specific questions that you've accumulated on these tax credits. We'll be running through them. And Lynn, you mentioned that we were doing this in a two-parter series, and what's really come about as we've been delving into this is this might be part one, and then part two, A, B, C, D, E, and F, because the complicated nature of each one of these tax credits this is going to need a fair amount of study and articulation of folks. We'll get into as much as we can today, but certainly this is a crystal ball gazing exercise rather than something that anybody should take as rote, partially because it's not rote yet. It's not in the tax code. None of this is. What we have is drafts, press releases, and what we know from various different sources. So there's definitely some reading and auguring of the entrails in this. But what we wanted to do was give people a chance to plan, even if that plan is only 10% accurate. Start planning around it, because some of this, like, you know, if we talk about the SHRED program, SHRED is all about planning and documentation. Your technology has to be good and you have to be pushing the bounds of it, but if you're not substantiating it and gathering your evidence and really documenting that, you lose your credits if you can't defend it, as Jonathan well knows. And the same goes for some of these programs, as I think we're probably going to see. So definitely this is a part one. But one of the first things we wanted to talk about was, you know, what are the common elements amongst these three? And there's a few. So a few, and certainly Jigna and Jonathan jump in as we go. A few that I have noted that a lot of folks have been asking me questions about are, you know, how do these actually work? So these are tax credits, so they're filed with your taxes. So you accumulate them over the year as at your fiscal year end, like your SHRED tax credits. You bundle it all up. You work with wonderful accounting services and boutique firms to quantify those credits, and hopefully have been working all year to document those, and send it off to CRA, and then wait for your check. So that's functionally that's how those work. And in this case, they are all three, unless you owe money to CRA, they always get theirs first. Unless you know, they are all refundable tax credits, which is important because that means you actually get cash versus a tax credit that you put against taxes owing. Jigna, Jonathan, any comments there?
Yeah, well, that's the very first thing, is that they're creditable, is interesting. And, you know, with SHRED, it's creditable at the CCPC stage, whereas these ones seem to be credible regardless, which it is a big development in terms of sort of flow. But one of the issues, anytime that you have a creditable, like actual cash money flowing out of the government, it attracts an audit. Okay, my experience has been, I have never seen a non-refundable tax credit audit. I've never had to fight one of those. Maybe there are bigger companies that do that, but it's really when the government has to pay money out cash, that's when it attracts an audit. And so, you know, these are going to be, you know, there are going to be disputes, there are going to be issues with them. And as you said, it does behoove you to sort of practice. Now, right now, as you mentioned, there's this form for SHRED, and what we're all doing, I think, is we're kind of extrapolating off of what we know about SHRED and extending it out into these new tax credits, which have very different parameters. And so one of the things that I would mechanically, they are all the same. This is what happens, is you qualify. Now, one of the mechanical differences that I think is big, and I don't know, we didn't practice who's going to say what about what, and believe me, unless you say, shut up, John, let somebody else talk, that's my secret sign for stopping to talk.
I'll mute you, don't worry.
So please, but that's the only, but one of the things I think that is very different, particularly about, you know, these tax credits, is that in some ways, you know, normally one of the bigger historical issues with the SHRED credit program has been that it is the Canada Revenue Agency that is determining the technical qualification. Are you doing SHRED? Are you actually sort of doing something new or innovative? Is there a technological advancement? Is there technological uncertainty? And my experience with the CRA is they are not good at that. Okay. and surprising, like even in situations where I had a client, which is the case I was talking about, where they were getting IRAP money. And you only get IRAP money if the government believes that you are on the leading edge of the technology, that you are doing something pretty cool. And meanwhile, the CRA is saying, oh, you got nothing, anybody, you could buy this at a street corner. And so the CRA's capacity to necessarily assess technology is, you know, in my experience, mostly because I deal with the fights, not the ones that we're through, tends to be pretty bad. So what's unique about this one, and at least about the just to make sure I'm technically correct, about the CCUS one, is that the technical authority is the Department of Natural Resources, which is fantastic. That is a great improvement. Now it's unclear with the CleanTech credit and the hydrogen credit.
Yeah.
That it is actually going to be the Department of Natural Resources or Industry Canada, which would be just as good as long as it's not the CRA doing the technical audit. You know, I don't mind CRA officers doing financial audits. They're accountants, they know what they're doing. But in terms of technical stuff, I'm, you know, less than impressed. That's basically my background. But as a consequence, if this innovation, and what's interesting about this is it's a learning that might have come from Australia, because in Australia, they bifurcate the responsibility on their investment tax credits for scientific research program between having the Australian Tax Office do the financial audit and then have their equivalent of Industry Australia or whatever do the technical aspect of it.
I believe
that's my first take on it. So.
Yeah, I believe the UK government does that as well, and there looks to be some early indications that a similar structure may be for the hydrogen side, because these are both fairly unknown technologies versus the clean technologies, and we should probably talk a little bit about you know, when you can sort of apply for these and what these actually cover, which is mostly the capital assets, but the discussion around hydrogen talks more about projects, which is much more similar to the discussion in what's drafted with the CCUS draft legislation, which is those projects are adjudicated by and approved by natural resources. So it looks like it may be natural resources perhaps that's doing that for hydrogen. We don't know, versus clean technology, where the language seems to be much more about the specific capital asset, the battery, the turbine, you know, it seems to be much more concrete in that way. So it may be a schedule, for example. We don't know, but it may be more of a schedule on the tax T2. And just one other commonality of two programs before I passed over to Jigna. A question I keep getting from folks is, when can I apply for these? When can I start accruing? So CCUS was actually, and this was a surprise to me when I dug into the literature, apparently one could have started accruing as of January 1st, 2022. The program wasn't announced at that point, but that's the date that I'm finding in the draft legislation. So that was interesting. The other two, hydrogen and clean technology, are as at the budget 2023. So when you hear the budget being announced, that is a definite cue to tune in this year. And we think there may also be some other things in there as well. Hopefully,
Brian, I was just going to say, and maybe we can hop into that. That a lot of the questions seem to be that we sort of have jumped into the deep end. If we could just, it seems like a lot of the questions are, what are the credits? How much are they? You know, a listing of what it is that we're talking about to start off. It does seem to be sort of the expertitis is, you're like, we've been in this and we're so focused on all of them that we're trying to make sense of them rather than just sort of define them. So I don't know if that was in the schedule, but that's what we need to do next.
Absolutely. And that's what I wanted to pass over to Jigna a little bit, if you're willing to field that one.
Yeah, absolutely. Thank you. So just to give everybody a quick background. So the reason we're doing this is if you go back to the fall 2022 economic statement, this is when the government actually announced additional measures that they wanted to encourage investment in the technologies, right, to help achieve the government's 2050 goal of the net zero emissions. And when the budget came out in 2022, they specifically talked about 3 different credits, which are the ones that we want to talk about. And I know we kind of skipped over it, but the 3 ones that we are going to really focus on today are the CCUS, which is the carbon capture, utilization, and storage, the clean technology investment tax credit, and the clean hydrogen tax credit. And to give everyone a sense of, why did this all come about? A lot of this was actually in response to the U.S. Inflation Reduction Act, and U.S. being, a strong economy that they are, they had actually announced nearly $400 billion that they would allocate towards, a better, cleaner economy. Some of these don't even have some caps, so it's estimated to be even closer to $800 billion that they have to offer to this. So of course, Canada, in order to be competitive, we announced these 3 credits. So going a little bit into a little bit of the weeds of these 3 different programs, I know we kind of covered what is common or a common thread amongst them in terms of the fact that they're all refundable investment tax credits. Let's talk a little bit more in terms of, what is the amount that a company can actually get back through these different credits and what kind of projects would be eligible. So when you look at the CCUS, you can look at this program as probably being quite generous because you can get anywhere from 40 to 60% back. And the amounts that you get back depend on a number of different classes or depends on where your expenditures are being spent. So for example, 60% is towards equipment that is related to direct air capture. 50% it says is, other measures. And then for other types of expenditures related to carbon transportation, storage, and use, the rates go anywhere from 37.5% for expenditures incurred from 2021 to 2031, and then 18.75% for expenditures after 2030, but up to 2041, after which it kind of comes down to 0. So that is a very generous program, as we have seen. Now, in terms of, which projects would qualify, wouldn't, of course, the government's looking for project plans. They really want you to identify how you're going to be implementing these technologies within your work. So there's a number of different things that they require you to complete. But again, as we've talked about, this is not in the legislature yet. So we're still trying to figure out what the application process is going to look like, presumably something similar to the SR&ED program. Jonathan, I don't know if you want to cover off clean hydrogen. Oh, you're on mute.
I have to unmute. Sorry, Brian. Would you like to do the summary, or do you want me to go into the clean technology?
I mean, so hydrogen. Again, we don't know the details on this. It is looking like it's going to be a project plan. 40% of that project coverage, it would be, and the capital involved in that project would be the amount that one can recover. And I was just answering a couple questions in the chat here. We're calling these CCUS, hydrogen, and clean tech. That's actually the name that they're using in the budget and the legislation. So I know there were a couple questions of what are these actually called. There's not a funky acronym yet, like SHRED, which is really, as I say, the kind of closest genetic neighbor of these tax credits, which is why we keep referencing it. But those are actually the names, and we'll send. We're hoping to have an iterative cheat sheet on all of this. So that we can send that out to folks. But for hydrogen itself, yeah, you're looking at about 40% refundable. It is mitigated by some labor market conditions, which is another topic that is probably beyond the scope really of this. But there's another angle that the government wants to see that the labor that's going into these projects is being done, things are being done properly, and if they're not, you do lose actually a significant portion of these credits, and so that's there's a whole write-up on the labor conditions guidance. But hydrogen itself, you're looking at about 40% on the unlikely just the capital expense that goes into that.
And one difference I think we should address with this, Brian, is the fact that when you think about the hydrogen and the CleanTech tax credits, those are only eligible from the budget release date.
Yeah.
So unlike the previous one that we talked about, this is really from budget release date all the way up to 2040.
Yep. So don't buy your batteries yet. Have those
Start
delivered
planning.
sometime in April, May. It was a little strange that they pegged it to the budget. I suspect that's because they weren't sure when they were actually going to have the legislation done. So definitely take a look at that. And the hydrogen is even more vague than the CCUS, and certainly more vague than the clean technology one. The clean technology tax credit, which is 30%. Is very concrete. There's a whole slew of clean technologies that we are wondering, can they be included in this? But they are talking about electrical generation systems, solar PVs, small modular nuclear reactors, wind, solar, water, so the generation side, stationary storage, batteries, flywheels, supercapacitors, our wonderful friends at HydroStore, long duration energy storage, eZinc, hopefully will benefit from these, though again, they are capital tax credits, not producer tax credits. So it's the people buying it, not necessarily the people selling it, that can benefit from these directly. And so hydrogen is, as I say, very much up in the air still, and we'll keep you updated. And I think I kind of jumped into covering the clean technology tax credits there a little bit. Jigna, is there anything else? As I say, the clean technology is refundable at a 30% rate. So it's the lowest of the three, but it's also the most predictable of the technologies. And as I say, the wording so far does not seem to be reliant on project plans or the like. So we don't know, but Gina?
Yeah, no, the only thing I would add to that is the 30% is only up until 2031.
Yes.
And then after that, it is getting phased out. So 2032, it goes down to 20%. Next year after that, 10%, the following year, 5%, and will likely be phased out by 2040. So that's just something to consider.
Yeah, and that phased approach is actually across the board too. So in the documentation on the CCUS tax credit, and I do know that we are jumping around between tax credits, and this might be why we're doing part 2, A, B, C, and D to break those apart a little bit. But even the CCUS, from 22 to 30, for direct air capture, you're getting that top end 60% tax credit if you're doing that direct air capture. By the time 2031 rolls around, you're getting the top end is 30%, and after 2040 it's 0. So those numbers may change in the budget. I've heard rumblings of caps being removed and budgets, timelines changing a little bit, but as at now, the goal is to really accelerate these at the front end, or sooner rather than later, because we need to.
Yeah. One of the things one of the questions that sort of come up through the questions is, are these things stackable? And I think the answer would be yes, but. Okay. So the first issue I would say is that because these are capital investment ITCs, shred credits are for the most part about expenditures on research, okay, which is very labor intensive. It's driven off of your labor costs in Canada to do this research and do the development. So these ones are basically about buying stuff. Okay, if you look at it, it's buying things to implement these things. And so if it, and so what they've done is they basically said, if it costs you, $10 million to put your project together, if it qualifies, you could get $6 million back. And I think that's sort of the bottom line of it. You could, if you qualify and if you do it quickly enough and you do that. One of the things that I find, and so as a consequence, but there is lines in there that talk about, it's the same issue with shred, sorry to go back to shred, about government assistance. And, does the fact that you're getting money from shred to do the research, does that come off of this? And the answer is definitely maybe, depending upon, you could say, well, I bought this stuff, but we did a bunch of research to implement it, because what you find in shred is what I call the ABC machine problem of, we have this machine, we know it works. We have this machine, we know it works. We have A machine, B machine, C machine. We plug them all together and they don't work the way that we anticipated, or as well, or as efficiently. Or sometimes they just stop because they're not built to work together. And there's a great deal of work to do, both engineering wise, software wise, for sure, and a lot of other areas to implement them and to make them all work together. So you're going to get a lot of what, so there will be, I think, the possibility for the combination of them, for doing the work that is actually research into making this stuff actually hum the way it's supposed to, or work the way it's supposed to in your circumstances. So I think the answer is definitely maybe, but this is the kind of area, this government assistance and what kind of assistance and where you're getting it from, that does create problems. And so, in this case, it's not about, sort of, it will be, I think, much clearer. But what is interesting is because there's labor market condition aspects to both of the clean tech and the hydrogen tech ones, on a capital investment project, they're going to put limitations on the way that you pay and deal with people. So I think those things will sort of start to intermix. And that is a big issue. The other sort of issue is that, what I find interesting is that although, and tell me if I'm wrong here, Brian, is that the clean tech credits, I have heard basic rumblings, and I've been looking around trying to confirm this, but seem to be flow throughable.
So there's certainly in the critical minerals that looks like flow through tax, that was in the budget. I don't know about the clean tech tax credits.
Yeah. So have you heard anything about those ones being flow throughable?
That only on the critical minerals side. I haven't heard it on the clean tech. We'll certainly be watching for that, because that could certainly change the economics even more so. I've seen
Yeah, and that's what I was trying to say, is that, the bell and whistle on these things that they're kind of missing is the flow through shareability of that, which would create an incentive for people. The good news is they sort of started with the first piece of it, which is they're saying the partnership aspects, if the flow through credits or if the credits are creditable, they can flow through to partners, which means that you could have limited partners who have made investments in these projects, if you had a limited partnership, and then, and paid for these projects, who could then turn around and get tax credits, refundable tax credits back. So, they might not have put the flow through share mechanism in there, but they certainly have started, sort of an alternative sort of partnership funding structure that is, the way they've worded it is right now is saying the partnership provisions apply, right? And so I think that's an interesting aspect of the sort of this, as the tax lawyer brain goes, hey, how do we set up a structure to do this? And one of the points that you had brought up as well is that it's interesting that these are refundable credits. They're for projects. Clearly, hydrogen and the clean tech use and storage one is about projects that are going to get approved. So you get your project approved. And that's one of the things that makes it very different than the SHRED program, is that, you kind of have this, stamp of approval that your project is one of those projects that they plan on kind of funding up front. So unlike SHRED, which tends to be sort of back-ended, where you're trying to gather up the information after the fact, it almost seems like you have to sort of get your project plan approved, like, as a priority
at the front end. And actually, Jake, I might throw that part over to you, and then I want to spend 5 minutes on sort of what could go wrong here, and then I wanted to open it up to questions, because there's a lot of them coming in. And Jake,
I've been trying to answer questions.
I saw that in the chat there. Thank you. Jake, one of the things with that project plan, is variance from that plan if you don't quite meet that plan. And so there's absolutely a whole substantiation chain that companies have to maintain for the CCUS side of things. We don't know if it's going to need to be there in the hydrogen, and we don't know if it's going to need to be in the clean tech side, about your impact and how much carbon you basically drawn down, used, and stored. Can you talk about that for just a second, and then maybe we'll flip into sort of some of the things that we could go wrong. Maybe this is a good segue.
For sure. No, and that's a great point as well that you bring up, right? Because at the end of the day, as companies are trying to plan for these projects, how do you exactly know how much carbon you're actually capturing, and what is the measure that they're going to use to do that, right? You could install something that will actually help reduce your carbon footprint, but how are you measuring this? And which documentation are you going to use to actually measure this? What documentation is going to be required to be, submitted when the government is actually going to assess which projects qualify or not? So to your point about, what happens if the scope of your project changes? What will the company need to do? So essentially what we understand from what has been, mentioned so far is that you will need to file a new project plan for that project with the Minister of Natural Resources. Now, the plan, if there is going to be a reduction of more than 5% in the amount or the quantity of the captured carbon that you're expected to support, then we'll need to really understand, whether your eligibility will come through or not, right? So it will need to be seen over a 5-year period over the life of the project. What documentation is going to be required in order to actually assess that? That's TBD at this point in time, but there are going to be some, planning and vetting to be done in order to really assess where the eligibility will come in. Oh, Brian, you're on mute.
Yep.
I did it to myself this time. My apologies. I was just saying documentation, and I'm referring again to our genetic next neighbor, Shred, tends to be where a lot of companies fall down. Maybe that's a good segue for just 5 minutes on, the 2 or 3 key screaming things that you would recommend companies pay attention to if they're going to, what are the failure modes that you guys are seeing from both a tax and a legal perspective for these tax credits coming down the pipe? Gina, you're off mute already. So, are there any?
Sure.
Yeah, please.
So what I would first of all say is there's going to be a lot of planning that's going to be needed. Once we actually understand the details about these programs and what is or isn't going to be eligible in terms of, what kind of documentation is going to be required, what steps a company is going to need to do, planning is going to be the most important thing. So I think that's the one thing I would highly recommend everyone do. What's the best thing you could do to mitigate your risk is plan for everything, right? That you need to qualify for these tax credits. So that's the first thing. And then I think it's really understanding and speaking with other agencies, right? Speaking with the government to say, this is what we're thinking of doing. Will this actually qualify or not? You really need to be able to talk to different angles, right? You want to talk to the ones that are actually going to develop the technology and the ones that are going to implement the technology, and understand that we're all working together to meet the requirements of these programs. So that's probably the first thing that I would think of when we think about what couldn't go wrong, is just really making sure you've got all your T's crossed and all your I's dotted.
Perfect. And Jonathan, you're on mute, but what do you see as some of the big issues?
I just unmuted myself in a timely manner that time. So the first thing I would say is that, the big issue that you see, and again, we're going back to the genetic roots of these programs and their organic nearest competitor of Shred, is that programs, Shred is supposed to be an incentive program, which is supposed to incentivize people to do it. The problem is it's morphed into a compliance program where the CRA seems to act as though it's their money and they're not giving it out. Okay. And so, as you said, it's about planning and organizing. But one of the things I would say is that on the technical side, as I said, the great part about these plans in advance is that you can sort of almost get the technical part of it out of the way first by having natural resources with the CCUS part, and hopefully it'll be same with hydrogen where it's project focused. But I would say that our big fight every single time that we get into a dispute with the Canada Revenue Agency over whether or not your technology qualifies for this particular issue, as to whether or not you've advanced it or whether or not you qualify, has been finding a suitable expert to actually be able to say and go back to them and saying, we have a full professor at the University of Toronto who says we're good. do you have one of those? We said we have one. And so, and our biggest problem is that we're doing this after the fact, trying to find somebody, and we're talking about something that was like 10 years ago, this was advanced, but everybody knows about it now. So it's very difficult to find somebody very often and I'm thinking more of the clean tech area now, where, who can you get as an expert to vouch for you, and to start thinking about that from the very beginning, because if you do get into a dispute and there's a complaint or a problem, that's going to be the most critical component. And the problem is, it can't be somebody who's related to you. Like, it can't be your, you and your college roommate planned this thing together. So, but now he's out. You can't use him. You can't use anybody who worked for you. You really don't want to use any of your competitors. And people like yourself, who's in the clean tech area as someone who's involved in the credit side of it, are all disqualified as well, because we're seen as self-serving, right? So who is it that's an arm's length third party that can vouch for the fact that your clean tech is as good as you say it is, and that this qualifies under the program, is probably somebody you should be thinking about. Who are the smart people in this industry, and having them on speed dial, just in case, even during the project stage, so that they're along for the ride with you. And I think that's very, maybe that's me being a little bit too pessimistic, but if you're doing your planning, you kind of need to have those sorts of, you need to have your consultant, somebody who can really argue with natural resources if they disagree, who can talk about your engineering and stuff and saying this is good, and then also have a backup just in case you wind up in a dispute, because that person who consulted with you is now no longer a good witness.
So,
right. So
one question I've got, actually, is Lynn in the chat here. Are there other proxy organizations that we can look at? Have you seen history with, IRAP said this was good, so CRA, you should accept it, or SDTC? I mean, we've got CleanTech, we've got SDTC. They've been wonderful partners in this ecosystem for many, many years, funding clean technologies. Would they? I mean, they also get their money from the government, so they're LP.
The answer is exactly the opposite. I've literally been in a case where we said, look, IRAP and Industry Canada are saying these guys are great, and you're saying they got nothing. The CRA does not care about what anybody else in the government says, and they actually sort of look at you like you're insane. Like, what do you mean there's somebody else who could, other than us, who gets to have a say on this? So
if natural resources is the arbiter, and it looks like it is for CCUS, we don't know about the other two, that could actually be a boon. That is
a boon. That is a great thing. It would be great if natural resources and or Industry Canada were the arbitrator of hydrogen and clean tech, to say, no, you're good. And if you could get that plan and project in advance, on that technology side, that you're good and that you qualify. And in this case, the difference is that you're not looking for an advancement. You're just looking for qualification of being a proper investment in this area. So it shouldn't be quite as disputable. Either it qualifies or it doesn't. But just with the history of having to fight these things, and you always have to remember that, like I said, if you're talking to your tax lawyer, Mr. Nice Guy days are all over. It's like they're saying no, we're saying yes. It's not a debate anymore. We're into an actual dispute. And so, I tend to be very what if push comes to shove? How are you going to be the one pushing, rather than but the way to avoid that is to have the continuous engagement by these third-party experts. And I think it would be more likely that, various aspects, Natural Resources Canada seems to be more likely to listen to other organizations within the government than the CRA. So I'm really hoping that it's not the CRA that's the arbitrator. Like, I don't mind financial audits, like that's fine, they're good at that. But on technology stuff, it would be great. And I also like the idea of actually getting your plan almost pre-approved, and then yes, you have to walk your walk. You can't just talk, can't just have a plan and then not execute. You have to walk the walk. But I kind of like that as being good, being a very effective way of avoiding these disputes.
So do the project planning and then work with folks to help you manage that information along the way, like Jigna and her team or what have you. And hey, if you get a really good asset out of that, a receivable on your balance sheet, we can always have a chat about Venbridge and looking at funding that tax credit as well. But I have a lot of questions questions coming in here. I do have a couple that were submitted before the actual event, so I do want to give them priority here. Lynn and Lynn has agreed to graciously help manage some of the Q&A while I manage the devices here. One of the questions here, and I'll throw it out to the panel, is embedded technologies, and there's a couple of questions that are similar to this in there. What about the case where you have a clean tech company that has a wonderful de-icing or turbine technology for a wind farm? The capital, does that count in the calculation for the clean tech tax credit, for example, or the software that's embedded in the battery management system? Does that count? Can you get the tax credit on those things? Gina, Jonathan, I have my own thoughts, but I'll throw it out to you folks.
Gina, what do you think about the software one in particular?
Yeah, and I think as we were talking before about this as well, Brian, I think it comes down to looking at the individual elements within a piece of equipment, right? So whether it's the software, the hardware, even the pieces that all go into it. I don't know, to be honest, about the software part. I'm not sure. I don't know if you have thoughts around that, Jonathan or Brian, but I'm not sure about the software. I haven't seen anything written about it, so I'm not clear on that.
So this seems to be capital investment focused, right? So it's about buying stuff. So what's interesting is that if you're a great Canadian company with a great technology, you're not going to get these credits. It's going to be your client who gets these credits when they buy it from you. Right. Now, does that make it more likely that a Canadian company is going to make a sale to a Canadian company for buying it? But what's interesting about this, though, is, and what's sort of, is this, there was a question about Canadian content. It's like, so you're a great Canadian company, you want to do this, but you're buying everything from the Americans. Do you get your credit? The answer seems to be yes. Okay. It is not there is no sort of, Canadian content obligation or requirement. It merely means, are you putting this in place? And so from a sort of a Canadian technology development perspective, this is, this is the kind of the weird bit about where this is going and the way that it could, and this goes back to messing it up. It's like, so the Americans do something that makes it really cheap and efficient for somebody to produce this stuff, and the Canadian government's made it really easy to buy it. So the smart thing might be to buy it from the Americans rather than do anything in Canada, because you're going to double dip on both sides and nobody's going to complain, because the credits go to the producer over there and go to the consumer here. And so all we've done is just made ourselves super consumers rather than producers. Now
and wiped out our entire clean tech ecosystem. So I'm very much hoping to see some producer tax credits, and I know there's been lots of voices speaking about that in this next upcoming federal budget, because it was certainly absent in the last two, and definitely not absent in the Inflation Reduction Act. So we're really hoping to see that.
Very clearly not. So there is, so that, that's more of a policy hole in this thing that I think it could cause all kinds of mayhem. And so, but at the same time, it is in fact, so what it means though, is it because of this partnership qualification situation though, is if you had a client, it may be that you might really want them to become your partner, so that you can supply this stuff and then you be part of the partnership. And then if you think about it from a partnership, it's carrying on business with you in common. It's like they're going to operate it, they're going to run it, you're going to supply it, but you're going to get 40% of the partnership interest of the project because you gave the stuff in for free, which means you're going to get 40% of the credits back, right? So as a tax lawyer, that to me seems like a structuring opportunity. That's the way that you actually could, as a producer, get into this. But it's because of the fact that you're willing to set up a limited partnership with your clients and say to them, hey, have I got a deal for you? Okay, I want to be, and as a Canadian producer, it's like, well, rather than you create the technology and then sell it, create the technology and license it, you might want to be much more in the business of saying, no, we're going to give our stuff away for free so that we get the credits back. Or because this is the other thing, is assignment of credits is also something based on the partnership structure agreement, right? So there isn't anything in there that says maybe there can be an unequal distribution of credits based on who contributed assets to the project up front. There's a thought. There's nothing in there about it, but like I said, that's tax lawyer brain going, woohoo, how can I play with this?
But Jonathan, it is one of my biggest questions, and a number of the questions from some of our CCUS companies and a bunch of other companies that I know have had, which is, as a clean tech company, can I buy my own technology and deploy it and become a clean tech as a hardware as a service company? Do I need a project co in there, that deploys that? Do I need a partnership? And the answer is we're not quite sure yet.
It seems bizarre that sort of the the structuring of this is going to be sort of dependent on the way that they build the credits. And I would say that it does mean that you're, what I would say in terms of blatant plugs is that, of course, when these tax credits are going out and you're thinking about them, you need to be talking to your local friendly neighborhood tax lawyer about how you're going to structure your project. And the second that you have a client who looks like they're going to buy, you have to say, well, wait, just have I got a deal for you? There's a better way to go about doing this. And right now that seems to be the way. Now, if there are producer tax credits coming down the line, or they reorient them towards producers rather than consumers, then that changes things. And with the amount of complaining. But that also goes to the issue of, these tax credits as designed right now they're in draft form. Okay.
Yes.
And so they are not, ordered to the Ways and Means Committee of Parliament, meaning they are drafted. But it seems to me that the industry itself has to engage in a very strong lobbying effort to sort of ask these hard questions and to say, do you realize that this is what could happen based on the way you drafted this now? Or are you going to stop us from doing this simply because it's the only way we can access them? So, we can move on to different questions, but there's going to be a lot of lobbying.
I won't pull up the slides, but I will put a shameless plug for the advocacy, not lobbying, agency and group of the Ontario Clean Tech Industry Association, which I might be a board member of. But a lot of that work is sort of the work that Octia, Ecotech Quebec, Canada Clean Tech Alliance have been doing behind the scenes, and a whole slew of chorus of others. So I did want to, I'll give a little plug there. One other thing I did want to do, and then we got to get into Q&A. I wanted to say it may be worth, given the fact that it is the capital asset that's being used as the basis for those tax credits. If you are a software company that is a battery management software company, you may want to create some really strong consortia partnerships with the battery producer. And you may want to embed your technology and be carried through their work as a way to access those credits. So, start having those conversations now as to who those partners might be, if you are sort of that technology that is in the back end that is not referenced in the clean technology tax credit list, but integral, literally and figuratively, to the functioning of that technology. And I'm picking on battery management systems, but it goes for the pitch motors for windmills, it goes to the de-icing, it goes to all of that. I think that may be something that you might want to start figuring out who your partners are logically to provide a full system, as opposed to just your component. And with that, I want to turn it over to Lynn, because we are horribly over time and there are a ton of questions, some of which we have addressed. But Lynn, are there any questions? And we'll try to answer some of these afterwards as well too. But are there any questions there that you wanted to tackle?
Yeah, I mean, and I like this one from our good friend Rick Findley. So hello, Rick, because I thought is quite impactful. So he said the issue about getting a third party at early stage is a real disincentive due typically to IP concerns and financial constraints. So, and I was sort of a little heartbroken when Jonathan said, well, STTC like wouldn't count, because they go through a rigorous process of both, selecting and funding the companies and then following them through and getting them to the end. So any ideas about, for companies that are, low on capital funds and are quite concerned about their IP, like who should they be talking to? And is this a question we should ask NRCan to say, hey, NRCan, if you're going to be doing this, who's a valid third party?
Yeah, that would be the first thing, is who is a valid third party to work on the technology. But the IP concerns, we live in a system of rule of law, so this is all about, and having proper NDAs in place and having proper incentives in place. If and having and working with people. Though I think that is the issue is, if your intellectual property is exposed, and you're going to have to be dealing with your trustworthy parties. And I just wanted to clarify, I just want to say the CRA takes the position they don't care what any other aspect of government says. However, if it's NRCan that is in fact dealing with this, then the group that you mentioned would be one that they would work with normally. Like, it just seems to be sort of this in the CRA DNA that they're like, yeah, whatever, we don't care. Like even inside the CRA, it's like you can tell them that this same company was audited by a different branch of the CRA and was fined for those exact same tax years. And they're like, yeah, we don't care. That they don't. That's not sort of in their process. But I would imagine that NRCan might be a little bit more collaborative and willing to work with work with other branches of government and other third party organizations like the industry associations. Say, yeah, we hear you. That seems to be something that is more likely to happen. That's why I was saying that having NRCan or Industry Canada as the arbitrator of what qualifies and what doesn't from a technical perspective is an improvement, is a move in the right direction. And so that would probably help out. Now, and when I say third party, I mean sort of, from the perspective of an expert witness, it's going to be mostly academics seem to be the strongest expert witnesses, people who are not necessarily in the industry themselves, but who know of the industry from their academic perspective, who are going to be the ones. And those professors and those instructors and those people in those industries, they tend to be, pretty serious about IP. So I'm not as worried about sort of IP leakage, so long as you're dealing with Canadian domestic partners. Then but the second it goes international, that's where you sort of get into real problems with the IP. So I like, it's a good question, but I think it is something that can be managed with good legal agreements and working with reasonable people. So.
Okay, great. Thank you. Peter McArthur has a question, but I think it's also, there's a suggestion in there as well. Like, if SCTC couldn't be used, could it be the third parties that SCTC itself uses? So when companies apply, they have to go through a third party to validate that the environmental benefits are there, and then at the end of the project, the third party goes back and says, yeah, this is where you ended. So perhaps that's it's a question and a suggestion to say, maybe you just reuse those same folks that you've already paid. And it's not a government department, it's a reputable. So thank you, Peter, for that. It's questions to.
Yeah. I think it's going to be much less of an issue.
There's another good one here, right? Oh, I'm hoping you're right. It's a very specific question here on CCUS. So the project plan appears to need to be pre-approved by NRCan. I heard that you don't need pre-approval if the project is below $100 million. Is that true? Who in particular should we talk to in the department?
Yeah, no clue.
I have no idea.
That I haven't seen. If anybody can find a reference from that for that stat, please send it to us, and we will integrate that in there. I have not seen that in the draft.
And my reaction to that would be, well, even if you are under, why wouldn't you go get yourself approved? Because the issue is from as you said, sort of all the things in the back end. It's like, now that you're approved for your project, now you can go out and do limited partnerships and effectively flow through this thing. Now that you've got approved, you can now factor this, right? Like, as you said, you can now borrow against it. So like, once you've got approved, that is going to be the basis for you to be able to finance this thing a lot more efficiently. Because prior to approval, I would say I'd look at it Picking another analogy, it's like National Instrument 43101 or 401 41101 from the mining industry. It's very hard to finance a mining project until you've actually gotten the stamp that yes, you can do this, and there's a national instrument in the securities law that says yes, you can actually talk about your mining project. So you get that, all of a sudden your financing opportunities just expand. So I would say the same thing. Even if you're a small project, I would do what you have to get it approved, just because now you can, you're not quite bankable, but holy cow, I got a lot of people to talk to might want to invest it. Prior to that, I'd be like, go get yourself approved, please. That would be my response to me. That would be my response. Somebody came to me and said, "Oh, I have a $25 million plan. How am I going to get this financed?" It's like,
if I had to put my Venbridge hat on, I think my underwriting folks would, if there was a clear path to de-risking that investment, so that it is more bankable, I suspect my underwriting folks would like us to do that, and like companies do that, and then again we could, in theory, factor or lend against those, finance those tax credits. Sorry.
Yeah, I mean, one question that's not here, but it actually came up in another call I had today is, what is your sense about whether the financial institutions will be open to lend against these tax credits as they have with SR&ED? Do you think it'll be, once it's clear, they're going to be good, or do you think there may be a delay? So when companies are sort of thinking about what's their, their capital plan as the budget, whenever that is in April-ish, will the banks, are they going to be ready to say, okay, we're good to go? If you're approved, we'll approve you.
So I'm horribly biased in my answer to this, and I'm sitting in the office of Silicon Valley Bank here, where they're hosting me. But from the discussions that I've had, it does not seem like it's going to be forthcoming, and that's one of the reasons why I've been really pushing this, and truthfully, one of the reasons that I joined Venbridge, because there does seem to be an appetite to fund those. There is a lot that we need to know, and there's a lot that we need to understand from an underwriting perspective, but there's certainly appetite versus in other areas where it does not seem like it's going to be forthcoming. So certainly watch this space. I will be shouting it from the rooftops, because I do think that debt stack, that financing stack, that could, these tax credits could play a material part. If you've got a CCUS, direct air capture, collecting 60 cents on the dollar for a $10 million project, and we can, and you can, so you're generating $6 million in tax credits, and we can finance 80% of those. Well, I mean, you might be able to do two projects, at once in parallel, as opposed to, because of the structure or the tax filing structure, filing that, or waiting, 1 year for those very lumpy tax credits, being able to draw down those throughout the year and undertake things either a little bit faster or maybe a couple different projects. To me, that's material, and it may be a good note to end on, because the goal of this is really to accelerate the deployment of all these technologies, and the bankability of those, or the funding of those, and the tax credits. All of this is going to come down to how many of these can we get in the ground, batteries, windmills, electrolyzers, all of it. And so, my hope on the Venbridge side, and the sort of general clean tech ecosystem, is that between the tax credits, the finance of the tax credits, the other aspects of debt and project financing that are coming down the pipes, and potentially producer tax credits, with all of those, that those will allow us to accelerate this, because I like breathing and I like water, and forest fires are not good for us, and unfortunately we're seeing way too much of that, and we don't have a lot of time. So hopefully this acts as an accelerant. We are over time, and just the nature of this discussion, I know has been scattershot, but the nature of these credits to a certain extent is a massive topic. We've barely scratched the surface of what we almost think we know. We will be having more of these webinars as the year progresses, as we start to firm up our knowledge. Hopefully the next one is with the actual legislation on one or more of these tax credits, but there may be another session in between of crystal ball gazing. So certainly stay tuned. Thank you for your time. Thank you, Lynn, Jonathan, Jigna, for joining me to walk down the road of auguring the future. As I say, we're probably wrong, but if we got you 10% closer to a plan, or got you thinking about some of the plans, whether it's partnership, embedding your technology, what have you, these are some of the strategies that should probably be on the table, and start thinking about those to see if they will come into focus as the right plan as this evolves. So thank you very much. Thank you to all our partners. I won't pull up the slides again, but thank you to EDC, the Trade Commissioner Services, City of Toronto, Swan Law, and every one of our other partners. Thank you very much, and have a wonderful day. Bye-bye.